I'm Mary Lyons, the Wealth Woman.
And I'm Eric Alexander with Benchmark Income Group.
Welcome to the Big Wealth Podcast. Today, we have a treat for you. Many of you have been asking specific questions about different types of investments. And one of the things that has been coming up repeatedly is the idea of real estate syndications. And so today we have a special guest with us. It is Jennifer Joyce, who is the owner and founder of JJ Capital Investments. She is an asset manager and a fund manager. And she manages over 460 million with 3,800 doors. So who better to ask questions than someone who has 22 years of real estate experience, who has built this empire in a very short 2.5-year time period. So Jennifer, welcome. We are so excited to have you here with us today.
Thank you, Mary. Thank you, Eric. I really appreciate you having me on the show.
Yeah, great having you. And before we get too deep in, because I know this is going to come up, none of the stuff we're going to talk about today is a specific recommendation. We're not saying, hey, go buy this syndicate, go buy this multifamily house. This is all about education and all about trying to understand kind of the world that we're operating in.
And now that compliance is satisfied, we're going to jump right into it.
Right.
So Jennifer, if you don't mind, tell us what you do.
Wow. So really, I acquire multifamily properties across America, crowdsourcing dollars through syndication. So each one of our addresses has usually over 100 doors apiece, and we have 50 to 70 investors that all come together to help us purchase that asset. And then we are the decision makers or the owners per se of that asset, taking those dollars, appreciating those dollars, and cash flowing those dollars through apartment complexes.
So tell me how you got into this.
Yeah, what's the origin story?
Oh man, it starts way back from my childhood. So my mother was a school teacher, but she kept every house she ever lived in. So she would rent it or own or finance it. And because she was a school teacher, all their leases happened to expire in the summertime. So who better to be her trash out crew and her maintenance crew and her lease up crew than the family? So, as a teenager, I was doing all of the things that, are exacerbated when you're a teenager. And so I came into my adulthood fearless about real estate. And shortly after that, the refi boom happened. And so not only the refi boom, but also you could buy houses for 100% financing, no doc, no credit, no income. Mm-hmm. And I just saw opportunity. So I bought as fast as I possibly could. I bought all new construction because I didn't want to swing a hammer anymore. And I thought I was going to save the world, and I put them all on Section 8. And so that's how I got my start as an owner operator in single family rental properties.
Nice.
And so then we went through 9/11, we went through 2008 economic correction, and we came out the other side of it. And at that point, we've been doing it about 15 years and started looking around going, there's got to be a better way, right? There's got to be more to this. Originally, it started out as my retirement plan for after 30 years in corporate America, right? That's what I thought I needed to do because Social Security wasn't guaranteed. So the stock market hasn't really been good since I was a young adult. And so we were looking for what else is there, but it started to get kind of, tiresome to take those phone calls on the holidays that my water heater needs something, my toilet needs something, my oven's not working for my guests coming for Christmas. And so we started looking around and stumbled into networking groups that talk about syndication. And, we felt late to the party because we'd already been doing this for 15 years. How did we miss the memo that you could crowdsource dollars to buy bigger real estate transactions? And so we started doing our research and found out that the Obama administration actually brought this about for the little guy. So there was something included in the Jobs Act that actually allowed somebody like me, small mom and pop, to syndicate large commercial transactions. No longer those hedge funds, those REITs, were the only ones who could do it before. Right. And then let's throw gasoline on that fire with the Trump administration. They came along and put together tax packages that incentivize people to do it by doing 100% bonus depreciation in year one of an acquisition of real estate. Oh, wow. So kind of when you saw everybody going out and buying an SUV in December because they want that tax credit at the end of the year, this is that same thing. They applied it over to the real estate side under the Trump administration. And so those two presidents in a row really changed the landscape. And I think that's why it's such a hot topic these days.
Wow, that's awesome. And have you enjoyed that ride up to this point, or do you see some things on the horizon that are sort of giving you guys pause, or at least taking away some of that?
But before we go that direction where we're forward looking, I actually want to address something that you just said, right? Which is that the ability for the mom and pop, for the little guy, to do these syndications, to actually be the one in charge of the crowdsourcing and the management of, there's a lot of opportunity there, but there's also a lot of risk, because there's no guarantee that the person who's doing the syndication is really qualified to be doing all of these things. And so I would love to hear from you as you were entering the space and getting to meet other people at these networking options. How did you identify who the good syndicators were, who they weren't, whether they were qualified to do these things? Give us some of that inside scoop, because I think a lot of times what our listeners are really looking for is somebody who can say, whatever you do, don't do these 5 things, and make sure you do these 3, or things won't work out.
Right.
Well, it is definitely a frenzy. And so a lot of those things are not vetted probably as well as they should be. But I kind of use the analogy of, if you go to the doctor, do you want to find out that they're still a resident, or do you want to find out what school they went to, who else has been successful at their practice getting care? So really what I found is, if you hang around the networking groups long enough, there'll start to be some grumbling about certain people or certain operators. And so you just need to do your due diligence on the sponsor team, is what we typically call the people at the top that are going to put the transaction together and then run that transaction and try to grow your investment. And so also I've noticed that if someone is not willing to be transparent, it's probably a red flag. So if you're willing to ask for additional documentation past what they provide, are they quick to send it, or are they saying, why do you need that, or non-responsive? And so what we learned through this process is they probably didn't have the background before they showed up in that networking environment to have a real estate background. We had a lot of owner operator days to try to work out the kinks ahead of time before we came over into this larger scale. And so then we started asking around, who's really good at asset management, who's really good at crowdsourcing the deal, or the dollars. And it's kind of a not an easy question to get answered, so you have to ask it a bunch of times. But you want to vet everyone in that room, because everybody's going to tell you that it's great. They're going to tell you they have all the accolades they need, but you really need to keep pressing until you make sure. With your doctors, you can find out where they went to school. You can find out how long they've been in practice. You can find out how successful they've been in the past. So you want to actually ask for referrals from business partners and prior investors. And also you want to see that they've been doing it longer than since the last crash. I would recommend that highly, that they've been around longer than that, and so that they know what that's like, especially with probably what Eric was referencing about, with what's coming, right? So.
Well, do you see that the single family background that you guys had gave you sort of credibility, or at least a leg up on the multifamily side, or did the skills translate?
The skills absolutely translate, because we went from 1 door to 100 doors. But the thing that we were most inspired by in this larger environment is the economies of scale brought about third-party property management, or in the single family rental space. A lot of times the way you make profit is you run it yourself. You might be able to afford it if you put a huge down payment or buy it cash outright to hire that third-party property manager. But still, a lot of times they're just another owner who decided to become a property manager. And it's not really at that corporate setting level. Over here, we can hold them accountable from our owner operator days, because we know better. We know how the eviction system works. We know how collections are due by the 4th. And so they can't just tell us that they're doing a good job. We know whether or not they're doing a good job. So all of that prior experience really helped us when we came over for operations, not so much for acquisitions. We kind of had to learn how to navigate the SEC rules, how to navigate to
Right.
be compliant and hire an attorney who understood it all. But that's something that you can do very easily in these networking groups as well, is get those skills on how to acquire at this level, because the lending space and the dollars are completely different. So it's another skill in our tool bucket now.
Yeah, but you had that once you got it. Mary and I joke that sometimes we're a dog chasing a car and we're not sure what to do with the car once we get it. Like, that's not our problem, but you've seen people have that issue, and you know what to do when you get the car. And I think that's really kind of cool, right? And so for the investors that come into that, I think the brilliant way you put that was this idea of crowdsourcing money, which I'm a giant fan of, sort of the concept in general, right? Do they have to be accredited before they can come to you, or can they be sort of mom and pop investors that are coming in as well?
So it depends on the sponsor team that puts the offering together, but there's different regulations where you can bring in sophisticated investors, which means they don't qualify for accredited just yet. And there's a couple ways to qualify, and I'm sure you guys can talk about that at another time about how to meet sophisticated or accredited. And then, we're starting to get to the point now where we're even looking for qualified, which is a step above accredited.
Mm-hmm.
Yeah.
And so all of those criteria help to protect the investor according to SEC definition. So they try to help an investor make sure they don't get in over their skis just because they may have come into some money, or they want to reallocate a 401k or a Roth IRA into a real estate transaction.
Right.
Yeah, I love that you're giving some tips on things to watch out for, because I can tell you, I've just heard some really crazy stories in that space. There was a friend of mine who early on getting involved in some of these deals, probably over a decade ago, ended up in a deal where the GP wasn't performing. And the way the contract was written, there needed to be a unanimous vote in order to get the GP out so that they could replace him. But the GP was a voting member. And so that makes a unanimous vote to kick him out incredibly difficult. And so there's just crazy situations where if you don't know what to look for in a legal contract either, there are like these gotchas that you're like, oh, well, if the deal is going well, it's not something that would ever come up. It's when the deal is going poorly that it suddenly comes up, and then there's an issue. And so I do think that sometimes, especially with less experienced investors, they look at a contract themselves and, will just sign on to it because they met you somewhere and they liked you and it all sound good, right? And so I think that one of the things that is incredibly important is having an attorney who specializes in that area look at the contract and tell you, this is normal, this is not normal, here's what that would look like if it became a problem. Are there any like really egregious things that you have seen in this space from operators or sponsor teams that you look at and you're like, man, it's a good thing that I didn't see that somewhere else?
Yeah, I would say if you're investing a significant amount of money, you want your legal counsel, not their legal counsel, to take a look and point things out to you and ask good questions. And, you want to have that back and forth, because this is a relationship. You're going to be involved in this transaction anywhere from 2 to 5 years minimum. And so, that's how long it takes to turn a business that's a little bit broken around that happens to be attached to a building. So there is a business inside that apartment complex that's making revenue. It's not just the structure. And so those legal documents, like you said, don't matter until things go wrong. And then they really matter.
Mm-hmm.
And not every set is going to be the same. So, and unfortunately, if you've got large amounts of money that you're investing, you want to bring somebody who's on your side in constantly to look at that legalistic side of the transaction. And so, investors, want to find something to discuss. That's a tough question, if not multiple, with that sponsor team, because then you're really getting to know them on a better level than just, hey, I really liked you at that event and I want to know more about your business. Now you're getting into, do they actually know what they're doing? And, that's part of it. They have to have, a competency in their own legal documents to be able to have the discussion with 50 to 70 investors each particular time. And so, it's some of the things that I find egregious really come around. Does the sponsor team make all their money before they start? And what I mean by that is not that they don't take an acquisition fee to take down the deal and get it done, get it closed, but is there also a huge construction management fee, a huge refinance fee, a huge asset management fee that exceeds maybe 2%, depending on the size of the purchase? And then is there a disposition fee, which is of the sale of the property? Or if you just see fee, or all of these things throughout the process, I would steer clear, because they're making all their money without performance, right? Like the fees apply no matter what.
Right.
And then you want to look at, they should also be providing underwriting. You can go a step further and you can ask for a copy of the profit and loss statement for the business. You can ask for a copy of the rent roll. So, there's going to be a rent amount and a delinquency amount for every single one of those people on the seller side that's given to the buyer side to buy that transaction. And so if you're looking into that part of it, then you want to see, how are they planning on growing the business? Do I believe that this is common sense? Are they doing it all by putting Amazon package storage facilities in, or are they doing it because all the comps in the area are higher for rent than the one they're buying? You use those skills. We don't have to have a background in real estate to just go, okay, this makes sense to me. They're actually going to increase the business in these different ways. And then if
adding
they're
value, essentially.
Yeah.
What are they doing something other than just owning it?
Right, because you want to know how they're growing your dollars. So
Right.
you've got to be able to see the business is growing dollars. So that should translate, right? And the fees can block some of that if it's too fee heavy. And then also, is the sponsor team incentivized through doing a good job in performance of the business, so that not just my cash flow grows, but they're incentivized to do above and beyond their projections, right? What's in it for them? And so how they get compensated is very important for them to stay engaged, but also we want it to be based off of your dollars are growing, so they're getting compensated as well.
Performance-based compensation as opposed
Right.
to just fee-based. I love
Right.
that. I think those are all things that are so important. And I think that initial discussion where you're asking for additional information and where your attorney is working with their attorney and how they respond during that is almost in some ways a little sneak peek, or pulling back the covers to see what is this person going to look like when there is a little bit of pressure. And I do think it's interesting, because I did have a conversation with a client recently who was like, is it normal to push back on a contract in a situation like this? And the answer is 100% yes. In business, it is always normal to push back on a contract and at least say, hey, would you be open to changing these things? This is what I've seen as normal. And how somebody responds in that situation tells you a lot about how they're going to respond when you're asking for something that might be outside the scope of what they would prefer.
Right. And you want to find a way to invest with people that have the same risk adversity as you. If they're going to run the business riskier than you would invest, it's not a good fit. If you find somebody who's really conservative and shows you all the different ways they're being extra conservative, then you ask those tough questions, those leading questions, and they answer them to your satisfaction, you are probably aligned on your risk adversity level for your investment strategy.
That's a great way to put that. And do you see some that have differing levels of debt that they want to carry? Some want to own it outright, some want max debt. Like, do you see that there's a sweet spot in the middle, or where they usually carry that?
No, it's all over the map. And I think it has a lot to do with the levers at the debt market level. So right now, the levers are coming, they're getting very conservative for what's coming, right? So you're seeing 55, maybe 60% leverage, where a year ago you could get 80%. You could get 80% on that, but they knew the appreciation was coming too, very rapidly. And we've seen that across America in this last year.
Right.
Well, now they realize that's starting to slow down to a halt. So they're not going to lend as much leverage as they normally would. And so really the debt markets will kind of dictate what is available to you. And then you have a decision above and beyond that where you can scale it back further. But it's usually pretty concise to what's happening across the national level.
Yeah.
So I think that's the perfect lead in to Eric's earlier question about what you
Yeah,
see
sorry,
coming.
I jumped the gun.
Yeah. I knew we were going to get here eventually, right?
But I want to know.
Well, I think I would love to hear a little bit about what you're doing as an owner operator right now, as a sponsor who's looking at the portfolio, both for existing members and then also for people who are considering doing deals in this environment, and what you think is wise, unwise with what we have going on today.
Sure. Yeah. Well, about 6 months ago, we took a hard look at everything and said, okay, the sales market is going to drastically slow down. So if we know that, and in commercial real estate, it takes at least 4 months to sell something, how do we pivot? So a lot of our conversations are, how do we pivot? We've been doing it since the pandemic. How do we pivot? And so in the last 6 months, we went, well, could we pull equity forward and cash out refi, which is a tax-free event? It keeps them in the skeletons they already know instead of a new set of addresses with new skeletons in an ever-changing debt market that's very volatile. So we decided to start cash out refining as much as we could away from the riskier debt options that were out there before. So if we were in sort of an institutional lending product, we moved to a government lending product. And a lot of the government lending products were actually created for downturns. So we're getting into a safer loan vehicle to offset what's coming and be ready for what's coming and work with people that understand what this looks like. And then, other ones, we know we're not done. And so we're having to go ahead and start telling the members, we're going to slow down on member distributions. Not that anything's wrong yet, but just like you want to hold your savings account just in case, it's time to start doing that. So out of protection of your dollars, we're going to start pulling back on that gas pedal. And if we would normally send $50,000 out a quarter or $50,000 a month, we're going to scale that back, and we're going to keep scaling it back till we feel like we're in a conservative place. And so a lot of them are really grateful or appreciative. And we also, at the same time, when we start changing how much the distributions are out to the investors, we start over communicating. So we know they're going to get nervous. We know they're hearing the news. We know all of those things, but we're supposed to be the subject matter expert in our field in multifamily. So we now need to over communicate all our action plans for everything that's going right and wrong. This is going right. However, we're also doing this. This isn't going well, but we have an action plan. Here's how long it'll take to implement. And so we have to actually communicate more often, because the fear is they get too scared and they start calling their bat phone, and the bat phone is at the federal level, right? So as well as managing those dollars, we don't also want to manage an audit when everything is going well and we're doing things for the right reasons. So we are starting to either cash out refi things so they can actually hop onto a second investment vehicle with those cash proceeds they receive, while the first one is still really doing its job for their investment strategy. Now their investment dollars are working twice as hard. The other way is we scale way back on the member distributions to get ready for a change in the business, a change in what people can afford in their rent payments.
Right.
While either the politics start to play their part in the upcoming election, or we're getting ready, honestly, for Black Friday to get here and show off the consumer confidence, which could really surprise some people, or they're in denial and they're just not taking hold of it till that happens. And so there's going to be kind of that rubber band effect where people get overly nervous about what's happening. We want to be over communicating before that happens. So we have to live almost in a crystal ball 6 months in advance of everybody around us. And that kind of really helps temper them.
I mean, I can say that like everybody and their brother seems to be syndicating apartments right now. I see it all over social media. And sometimes I look at the stuff that's happening and I'm like, I know these people and I know they're not asking the questions that you're asking about your business. And, you're looking at it, at least what it sounds like from what you're saying, from the standpoint of really taking care of the investors that are investing with you, as opposed to just looking at this as a vehicle that allows you to do certain things. And I think that anytime you are looking for something to invest in, getting to know the people who are giving advice at a personal level is so key going into environments like this, and asking them how they are thinking about the risk, because
Right.
the reality is that anybody can make money when the market is going gangbusters, and it doesn't matter which market we're talking
And
about.
when
It can
money's
be the
cheap,
stock
right?
market. Yeah, it can be real estate. It can be whatever it is. But where you really start to separate people, I think, is when markets are in serious downturn. That's when you see who's prudent, who's performing, that sort of thing. And I think it's very wise to try and figure that out ahead of time, because the word that you used earlier when you were describing the space, since the changes have occurred, was
Right.
frenzy. And I think
Yeah.
anytime there's a frenzy, people get careless because they're afraid they're going to miss opportunity. And that creates additional risk that they frequently don't need to take. And if they took a more prudent, I'm going to do this slowly, I'm going to make sure I know where all the risk is before I jump into something. Because when we operate from a space of abundance, and Eric, you and I spend a lot of time talking about this,
Right.
if you're operating from fear, whether it's fear of missing out or just fear of, oh, I can't do anything right now because I don't know what's going to happen, there's always scarcity. But when you are in that space of abundance, and if it's not this deal, there will be another deal, right? You tend to look at things in much more depth, and you can paint a much better picture of what's actually happening, so that you can make good decisions. So I love everything that you're saying right now. Where do you see the opportunity right now?
Opportunity right now is going to be in your aging A-class properties. So
Mhm.
your 90s builds is kind of the home stretch for me right now. The 60s, 70s, and early 80s is not. We're being very picky and trying to stay away from those, because we've capped out workforce housing at what they can afford. So if somebody hasn't gotten a pay increase in the last 12 months, and they're
Right.
working the same job, and their rent just went up by $150, to what end? You're going to either have more people move into that same unit, which isn't great for the unit, or
Right.
you're going to have them start defaulting. And are they going to pick the car, the house? It's a gamble. Every month is a gamble.
Right.
And so we're steering clear of those on an acquisition setting, because they're all maxed out, and everybody wants to get into that frenzy and ignore it and say, yes, those are the most consistent, the most cash flowing, the best properties to have upside, and you can do so much in CapEx to fix them up. But those are families. Those families can only be
Mhm.
strained so much. And when everybody has this moment of clarity around the holidays this year, uh, they're going to severely pull back in all directions. They're going to pull back on spending. They're going to pull back on, can they work remotely at their job if they're not already? And we're just not ready to see the delinquency that's going to be coming. But delinquency is something you sign up for in this business that we're in. We're in the business of apartment complexes. So when things are not going right for the blue collar worker, they're also not going right for the investor who invested in that building. So we have to make action plans around how to offset that alongside those families, because they're our customer base too. It's not just the investors we
All
have to
right.
think about, it's also them. And then I have a third customer base, which is my staff who works at those buildings. What about their families? Do they need a raise? Are they going to ask for one or quit? So we have to think about all three sets of clientele and come up with a strategy that keeps that building humming along while we have a small blip, just like we did after 2001 and 9/11. The world had to reset a little bit. And then 2008, we saw 40% of 401ks just disappear overnight, right?
Right.
That was not fun. And we're not headed for some good times here in the future either, if the stock market keeps, pulling those levers and things of that nature. We're also watching, a lot of models about, is this the 1980s? And I think at this point, I'm off of that bandwagon. I don't think we're there. I
Oh,
don't
really?
think we're going to see everything go to another comma behind it. I was there for probably 3 months and doing a bunch of research. So we put our heads down a lot and then come up for air and go yes or no. And
Mhm.
so, I think the presidential election will have a huge impact on this country and what happens
Yeah.
next. But we have to operate no matter who's in charge. We have to operate no matter whether the economy is up or down. And we have to have a strategy for all of it because people are counting on us.
Yeah. So when you say you were on the 80s bandwagon, but now you're not, are you talking about sort of for the interest rate environment, or what are you saying? You're not quite sure
The
you're there yet?
the extreme inflation, the
Yeah.
extreme inflation is it was definitely on our radar. Are we going to see houses, just go 20 times their value overnight?
Yeah.
Are we going to see interest rates in the banks go to 18% for a mortgage?
Right.
I've decided against that. I don't think that we're there. And it's just looking at the models and the data and everything presented at this time. I think it was more of a shock factor that things were moving too quickly and it wasn't good for our country. And now that we're seeing that slowdown, that's very reassuring.
Yeah.
That people are starting to they've done their migration, they've figured out what their new value systems are and moved to different parts of the country to support those, but it's not something we're going to see, continue to go on. And I think it's part of that is just we're 10 years behind on growth on the construction side, the ground up development. We
Yeah.
can't support people moving around the country as much as we would like. And so I think that helped as well.
So if somebody wants to dig deeper into some of these topics, because we're coming up on time.
Yeah. And I have one more question when you're done. So.
Oh, well, ask your question and then I'll ask this one. You go first.
Yeah. So I am a huge believer that market share is gained in the downturn, not in the upturn. And that a lot of times the people that shouldn't be in a market get pushed out of the market when it gets bad. And those are sort of buying opportunities, right? The construction company down the street was poorly managed. They didn't know what they were doing. The market dropped, they sold. That's a buying opportunity for somebody else. Do you see that sort of potential in that multifamily space of all these, the frenzy that you mentioned, the people that got in that probably don't deserve to be there or shouldn't be there? Do you see that as, because you talked about slowing down distributions, is some of that sort of quote unquote keeping your powder dry, so when some of those things go bad, you have the ability to swoop in and buy it on the cheap? Or is that something that happens in that sector?
That is going to happen, but I think we're another 6 to 12 months away from seeing that. There's some runways for these guys to mess it up a little bit longer, because there's a couple things they can do. They've stress tested their deals where when they bought them, if things were going well, we could pay the mortgage, pay the investors, pay the expenses. Well, the first one to go out of that is the investors. So
Right.
they'll start feeling it first. Then they won't be able to afford the expenses. So they'll start going delinquent on the expenses because you can't mess with the mortgage guy, right? That's the last thing to happen. So you've got to start getting rid of all the cash that goes to those other two buckets first. So we have some time ahead of us, and that actually allows people to get their dry powder ready. A lot of people tried to do it, I think, about a year ago, and that was a little early because we continued to appreciate, we continued to frenzy.
Right.
And so that's still coming. But you've also got investors are starting to scale back because they're seeing their distribution slow down. They're seeing things not appreciate like they used to or sell like they used to.
Right.
So they're going to have to get reassured on their confidence to reinvest. They're not going to be ready to do that right away. They're going to have to see some positive messaging out there before they're ready to go dry powder in a year. And if you don't have those two things happening at the same time, then here comes the hedge funds and the REITs anyway to scoop up all the damage control, right?
Right.
So there'll still be some people that make some serious money, but what will also happen in the next 12 months is the ones who shouldn't be here will fall away, and the ones that were supposed to be here all along, their names will be known, and so they'll be at that next level, and so you'll know who those people are that made it through this next correction.
Yeah.
So if our audience is intrigued and has more questions and they wanted to know more about what you're doing or syndications in general, how can they find you?
So we have a website, and it's www.jjcapitalinvestments.com. Our phone number and email is right on the website. This is a relationship business, so we don't have any gatekeepers or anything like that. You can get a hold of us directly. And we really only service a small clientele of investors. So we hope to work with people for the next 20 years, and we want to keep it that way as a small boutique white glove service.
Yeah.
Love it. Eric,
That's
where
awesome.
can I find you?
I'm at Economics with Eric, everywhere you use social media.
And you can find me at The Wealth Woman, again, wherever you use social media. Jennifer, thank you so much for joining us today. We're really grateful that you made time for this. And, hopefully the audience enjoyed what you had to say and learned something to boot.
Yeah.
My pleasure. Thank you, guys.
All right. Have a great day.